faithfully delivering value, exploring great books from around the world. Hello, this is Sally's Book Talk. Today we're discussing the book's premise, Fund Decoded, My Investment Journey and Practice by G. Kai Fan, also known as Lao K. It's an easy-to-understand primer on fund investment. Many people probably dream of having both leisure and wealth during retirement. Suppose you're 30 now. How can you accumulate 1 million by 60? The first method is straightforward. Save 2,777 yuan monthly for 30 years. The second method, find an investment with 12% annual return, only needing 300 yuan monthly. Same $1 million goal, but a nine-fold difference in financial pressure between methods. That's why finding effective investment methods makes financial goals achievable. But how to find investments with 12% returns? The answer is fund investment. Historically, U.S. funds average 10 to 15% returns. This book teaches classic fund strategies to protect assets and make money work for you. Author Lao K, an astronomy PhD, created popular investment blogs read by 5 million plus. This book distills his best blog content, reprinted over 10 times since publication, a practical guide endorsed by fund investors. The book contains approximately 190,000 words. Today's discussion has 4 parts, starting with 2 fundamental questions. What's the calculation problem? Determine your investment capacity before starting. If living paycheck to paycheck, focus on earning before investing. Invest only with disposable income after essential expenses. Lao K introduces 2 calculation methods in the book to help determine appropriate investment amounts. The first is the 1/3 rule. This simple method allocates 1/3 to real estate, 1/3 to securities markets. The remaining third goes to savings or government bonds. This mirrors ancient Western wisdom. Divide wealth equally between land, commerce, and reserves. The second method is the finger algorithm, adjusting investment ratios by age. Savings percentage equals your age. Investment percentage equals 100 minus your age. 75. Example, at 30, save 30%, invest up to 70%. At 40, save 40%, invest 60%. More conservative with age. Important warning, avoid using borrowed money for investments. Debt-driven investing leads to irrational gambling-like behavior. Now to our selection question. Choosing suitable fund types. Different goals and risk tolerances require different fund choices. For 20 to 30-year retirement planning, embrace aggressive growth funds. Consider small or mid-cap stock funds for maximum growth potential. For college funds with 10-plus year horizon, choose large-cap funds. Risk-averse investors should balance stock and bond funds. For 5 to 10-year horizons, for example, age 50 or more, prioritize stability. Even with strong risk tolerance, maintain bond fund allocation alongside stocks. Does higher risk always guarantee higher returns? Remember this crucial principle. Choosing low-risk, low-return options for long-term investments is unwise. Part 2. Selecting quality funds from thousands of market options. Professional rating agencies simplify fund selection through expert analysis. Lao K recommends Morningstar's independent global fund ratings, established in 1984. Morningstar evaluates both performance and risk factors in ratings. Higher returns inherently involve greater risk. High-yield funds carry corresponding risks. Funds achieving similar returns with lower risk prove more attractive. Morningstar converts risk into negative returns for adjusted comparisons. Funds are ranked by risk-adjusted returns within categories. Top 10% receive 5-star ratings, descending by percentile. While Morningstar provides excellent tools, deeper analysis is needed. Numerous 5-star funds still require further differentiation. How to choose among top-rated funds? Malke introduces 3 metrics: Sharpe ratio, alpha, and beta coefficients. Higher Sharpe ratios indicate better risk-adjusted returns. Alpha measures excess returns relative to market benchmarks. Beta quantifies volatility relative to the market. Index funds equals 1. Index funds mirror the market. Beta greater than 1 means higher volatility than market. Beta less than 1 means lower volatility. Okay, so For investors, higher alpha coefficients always mean better returns. Beta represents volatility, short-term risk. Lower values indicate stability. Sharp ratio balances returns and risks. Higher is better when factors are equal. Crucial. Compare these metrics only within same fund categories. Beyond ratings and metrics, two critical factors remain in fund selection. Fund managers and their companies require careful evaluation. First, fund managers. The fund manager's expertise directly impacts investment outcomes. Professional tenure is the primary evaluation criterion. Never trust fresh graduates with your investments, regardless of credentials. Investment success largely depends on practical experience. Ideal managers should have both bull and bear market experience. Long-tenured managers with proven track records are preferable. Second, fund companies. Managers rely on research teams and risk controls. Research teams provide stock pools, risk teams implement controls. Football analogy construction. Managers equals forwards, researchers equals midfielders, risk equals defenders. Consistent performance across all funds indicates strong company capabilities. Such companies generally offer more reliable funds. How to select funds. That concludes this section. Now, to part 3, two major pitfalls in fund investment.